Hey, great guys. It is September 27th, 2016. This is No Conference 3.0. I guess this is like our 200th session or so, and going strong. I've got a few people on tonight. Bruce, first of all, how you doing, Bruce?
I'm good. Hi, Mike. How are you?
Good. Yeah, we had a crazy week, huh?
Busy day, busy week.
Yeah.
It seems like it's Tuesday. It seems like Thursday already.
Just been really, really good. Yeah, here we go, crawling into October already. And, sheesh, so anyway, without much more, I just wanted to kind of touch base, as I always do, that this is, these webinars are just for educational purposes only and not for any type of legal advice or any type of accounting advice. If you need a professional, I advise you to not use us, okay? So tonight I've got a special guest on. It's a product that I've been using since I was introduced to the note business in 2007. I wanted to go ahead and figure out what the best way was for me to create amortization schedules and to do borrower loan workouts. And I came across a product called Time Value 5. And I've got the founding member on here who's been kind enough to give us some time tonight for our group to really walk us through the deals. What I've used this for, and still continue to this day to use this software, is to recreate the mortgage that was written whenever the origination took place in 2005, January 2005. I use it to test out and make sure that I am generating the correct monthly payment. If it's a 30-year fixed, I put in the interest rate, I put in the loan amount. I'll leave the payment amount unknown and hit calculate and see if the loan payment that I've come up with on using Time Value 5 shows up exactly the same as what's written on the note. And it works perfectly. It's worked flawlessly. I then recreate the mortgage and see where the borrower is supposed to be in the current date that we're in. So September 2016, this borrower should have a balance of $28,000, but I see that the borrower has a balance of $34,000. So I've got $6,000 of arrears, and it's a real quick way for me to calculate where we're supposed to be in the time value of money. So with that, I want to turn this over to, so we've got Marcus on here tonight. Marcus, how you doing, Marcus?
Doing very well. Thanks, Mike.
Hey, good. So Marcus, you're going to go ahead and give us a presentation tonight on the software. You want me to just turn over my screen to you?
Yep, mine's all ready.
Ready to go. Okay, great. Okay, so you should see a little window pop up that says that you are now the presenter. Here we go. Excellent.
Okay, how's that?
That's perfect.
Very good. All right, so thank you, Mike, and thank you, Bruce, for providing me the opportunity to present today.
Awesome.
On creative workout scenarios and partials. Doing a little bit of both here, and I get a ton of questions on both, so I want to be able to share that. And then secondly, thank you all for being here today and for this presentation, and hopefully you'll learn something that you can use tomorrow. And again, as Mike mentioned, my name's Marcus Ruscica. I've been at Time Value Software for over 8 years now, and been fortunate enough to work with many of you investors over the last few years to help with deal structuring and creating amortization schedules for your note deals. And very often, with just a little training, I find investors are often running with just a basic understanding of using T-value. Of course, I'm always available to help. Just a little background on Time Value Software. And Time Value Software has been involved in the note industry since, I'd say, the late 80s, early 90s, and has, for the most part, come to be a standard in the industry. And T-Value Software is our flagship product, originally created back in 1984, believe it or not. Back then, the owner of Time Value Software would go out and give presentations for using T-Value in the note business, and I'm just lucky enough to be able to kind of carry that on today and talk about creative ways of structuring deals and keeping track of loans with irregular payment scenarios. We've learned that providing amortization schedule can help initiate negotiation, where oftentimes being creative can be a key element to helping borrowers continue to make their payments and help build trust and understanding with other investors that you work with by having these tangible amortization schedule to add some clarity. One thing I often hear from new investors is that I'm just getting started and do not need T-value yet. And you know, I know a lot of people use different things, whether it be HPs or Excel. And I know that if you talk to a lot of the seasoned investors in the industry, you know, one of the things they're going to say is, hey, you want to get your head wrapped around the time value of money and structuring deals and the payments, you know, and understanding what kind of yield you're getting, but also, you know, how to structure those payments for a borrower. So today, I want to bring up just my contact information here before we begin, just in case some people are unable to be here at the end. I will also show it at the end. But today I'd like to show you some of the ways to verifying note terms, creating workout strategies or payment schedules for your borrowers to have success, and to clarify some of the complications investors have with regard to partials that often end with an early payoff. Now, there are many options when it comes to creating workouts to keep borrowers paying on a loan or making a re-performing note appealing to an investor. And it's in your best interest to make it a win-win deal. I know everybody has different strategies or exit strategies, but you want to make it a win-win deal as much as you can. And I hope to help your creative mind today. I understand that T-value may be new to some people out there, so I apologize if I go quickly through some of these scenarios. And I'll do my best to slow down, but keep in mind you can always reach me after the webinar or anytime via phone or email for help or questions with regard to T-value or what I go over today.
Cool. Yeah, and let me just add this real quick. This webinar is going to be recorded, so feel free to fly through it, and we'll give people the opportunity to go back and take a refresher again.
Very good. Okay, so as long as everybody can see my screen here, I'm going to go ahead and get started, give you a little background on time value software. And I want to share the core of what I'm going to go over today. And it's based off of these questions that I often get. One is, how can I create a workout when payments are missed, or even with a non-performing note where you're essentially buying a note with a balance, whether it be including arrears or not, but it may have had some history of non-payments or maybe some lump sum payments or payments in the past. So I want to go over that and answer that question a little bit. Second question, how do I create an amortization schedule for the partial or Schedule B? And there's often confusion with regard to this, so I want to help clear that up a little bit. And last but not least, what do I receive if the note pays off early? And I'm going to be able to show you how the amortization schedules and just going through this process is going to add a lot of clarity and hopefully answer some of your questions as well. So in doing that, here are the few things that I'm going to go over. Verifying a note payment schedule. Now, anytime you're going to buy a note, probably one of the first things you want to do is verify what this note actually looks like at this point in time. What the balance is, how many payments are left, maybe historically what has happened that brought it to the balance it is today. Sometimes it's good to know what the original note looked like so you can kind of see what it looked like from day one. Then we're going to go through some different workout scenario options when borrowers have missed some payments. And this is also very good with just starting with a new balance, whether you're bringing somebody current or you have a non-performing note and you're working with a principal amount and you want to structure it creatively to work for that borrower as well as yourself. And then creating partials, creating an Schedule A, B, and C, and this calculating what happens when a note pays off a little bit early. So verifying a note payment schedule. And let's say that we have a note here, and let's say this is the original note at $80,000 at 6% with a payment of $479, and it's a 30-year note. You know, the nice thing about using t-value is that you can solve for any one variable between the number of payments, the interest rate, the present value, which is also the loan amount or the pay price or your investment amount, and the payment. So of those four variables, as long as you know three, you can always back into the fourth. And I'm going to lay some of these calculations out in this fashion. I know a lot of people are familiar with looking at the variables this way, and it kind of keeps it pretty simple. And before I step over to t-value, I'm going to show you a couple other things that we're going to go over with regard to verifying that note. And one is, how do I verify the remaining number of payments? So one, we're verifying the original note. Two, we're going to verify the number of payments. And, you know, a lot of times, and I'm sure many of you have been through it, that, you know, you're looking to buy a note and somebody gives you information with regard to that note. Hey, here's the balance, this is the payment amount, here's how many payments are left, or whatever that might be. I spent a few years working with banks and credit unions over the last several years, and they went through, you know, the post-recession, issues with loans and going bad foreclosures and whatnot that began to pile up. And FDIC and NCUA would strongly encourage these institutions to create workouts and try to keep the borrowers paying and keep them in the home, because they were just piling up so much on their defaults and foreclosures that, you know, it was just looking really bad for the banks and credit unions. So one of the things they needed to do was create these workouts, and they had to do a loss calculation, which was what we were helping them with. But with regard to what I'm saying here, many times, more often than not probably, when I talk to somebody and they say, well, here's the balance on this note and there are 25 years left, or there are 315 payments, and then I would back into those numbers in t-value, and sometimes they would be missing a couple years of payments or more, or the balance was just not what they thought it would be, so they had to go back and kind of do a little research and figure out what happened. So definitely an important step to take. So in this question, verifying the remaining number of payments, we have the interest rate, the payment amount, and the balance. Then we can back in and solve for the number of payments that would be remaining. Again, I will lay it out in this fashion. Our unknown variable is going to be the number n, or the number of payments. In a t-value, we just type the letter u. It will actually say unknown in that variable. Along with that, I'm putting these together because you're going to see how easy it is to do these calculations, but also verify the current balance. So in the same note, let's just say we had other information. Our balance or our loan amount would be our unknown that we would solve for. So it's kind of flexible, and it's kind of nice to be able to have options and come from different angles on doing this. And in this, our unknown would be our present value or our loan amount to calculate what the balance would be. All right, so I want to take a step over to t-value and actually show you what this looks like. And today, if some of you are familiar with t-value, you probably haven't seen this version, which is our new t-value Online's cloud version. Works on any computer, Windows or Mac or any mobile device. Just log in to t-value Online. And it looks like this got a ton of new features as well. I'm not going to give you so much of a tour of the product today, but if you call me or have any questions, I'd be more than happy to. So we'll kind of get through these calculations. So what I want to do is kind of set up, let's just say, this original loan that we were talking about here at 6%, and I'm going to tap through these fields here, and let's just say that we had a loan of $80,000. Let's say this is the original note. And I would just solve for the payment amount here, and we would say that this is a 30-year loan. And then we would just solve for that payment amount. This ties out just fine. We can click on the amortization button up here, which is then going to show us the amortization schedule breakdown with the cash flow information, break down the payment, interest, principal, and balance information throughout the loan. So it's just nice to have and see what that original loan looked like before we start digging into the details. there's some handy features up here you'll see that we often use, but one of them, emailing a PDF, is kind of nice. If you are working with an investor or a borrower and you structure some sort of deal or a payment plan, and you can email it to somebody right away. Another function is export to CSV or even Excel. You'll see that later on I put these schedules into Excel to create a master schedule for the partials, which is very helpful. Okay, so let's say we're a few years into this, as the last couple slides noted, and let's say that we wanted to solve for what number of payments would be left. The balance on that, or the balance at this point in time, would be $76,867.19, and we want to solve for the number of payments that would be remaining on this. We just put an unknown in this variable. Hit calculate. It tells us 324 payments are left. Now, you know, the one thing that is interesting where you can kind of run in, and I'm sure you'll have a different conversation, that if somebody said, hey, there are 315 payments left on this note, and they told you maybe what the balance would be, or maybe they guessed, but if you back in and solve for that, and the balance is different than our 76,867, I think you're going to have a little different conversation before you decide to invest in this note, at least to get an understanding of the context of the note at this point in time and what it looks like. So as you can see, it's pretty easy to solve for any of those as long as you know 3 variables, but it's going to add some clarity to what that note looks like at this point in time. All right, so let me take a step back to the slides here, and we're going to go into some different workout scenarios. Okay, so how do I verify the balance when payments are missed? In this scenario, let's say 48 months into this payment schedule, the borrower misses the next 6 payments. You're going to have some different options. Or maybe you're wondering, what do I do at this point in time? Now, you can get creative and figure out ways that are going to work, you know, but if they haven't made payments for 6 months, you want to find something that's going to work for them and get them back on track with making payments. You can calculate a balance to pay now, which will be a big lump sum, to get them back on track with the payment they were scheduled to make to have the same maturity date. They could pay a balance at this point in time. I can calculate catch-up scenarios or catch-up payments for a period of time, whether it be 3 months, 6 months, a year, or however long you want it to be, that they would pay a little bit extra, and after that point in time, they would be back on track with their $479 payment, for example. Another option would be to add a forbearance to the back of the end, back of the note, or the back end, where you essentially have a balloon at the end. So that's another option. You can maybe even have them pay a little bit up front and then take the remainder of that balance out and move it to the back end of the note. And then lastly, we'll just kind of go over a little creative workout scenario. There's so many options to do, but just to show you one that's kind of worked out for some people recently that they actually like to implement into their workouts. So let's take a step over to t-value again. All right, so let's start with the original note on this, for example. Okay, so it was 360 payments, and we're saying that 48 months into the schedule, the borrower misses 6 payments. So one thing that's kind of nice here that I can do is I can hit this expand button here, which essentially spreads out all these cash flows. So any irregularities that have occurred, I can account for them, whether it be dates or amounts, extra payments, missed payments, etc. So let's go down to payment 48, and let's say after this point in time they missed the next 6 payments. So now here we are further down, and don't pay so much attention to these dates. If I move it back 5 years or 6 years, we'll be at the same point, but they're monthly periods, so all the same here. So at this point in time, if we wanted to calculate, well, what do they owe at this point in time to catch up, all I do is put an unknown variable here. If I need to change the date, that's fine, but essentially on their next payment, what they would owe would be what I would calculate here. $3,408 would be the amount that they would need to pay due to those missed payments to get back on track. And then they would essentially have the same maturity date at the end, and paying the same monthly payment of the $479. Well, in most situations, which I'm sure you're familiar with, is the borrower is going to say, I can't afford to pay that. I haven't paid the last 6 payments. How can I afford $3,400? So you say, okay, borrower, how about if I give you the next 6 payments, 6 payments to catch up. If you could pay the extra on this, then you'll be back on track with your $479 payment. Now, in some of these cases, maybe there is an option that you throw in that if they pay over a period of time consecutively, that maybe you reduce some principal. You can apply that in here as well. But in this case, if they pay $973 for the next 6 months, they'll be back on track. And again, this may not work out for them either. So, paying that extra amount, you never know what situation somebody is at and what they can afford. But if you present the options, you're going to see what's going to work best. So then the next option is, let me put some of these values back in here. The next option is to create a forbearance at the end. So maybe they don't pay anything. How many we have? 3, 4, 5, 6. Okay, so I can even maybe collect a little bit up front. If they gave me $1,000 or something like that, I can just change that amount here. But let's just say, for example, we're just going to add it to the back end of the loan. So what I can do is just compress all these cash flows back together. Then what I would do is just go down here, whether it be on the 360th payment or a month later, whatever that date would be, I would essentially add that amount to the end, and then that would tack on to the end. So those 6 payments add up to be a lot over 30 years with the time value of money. So it's an option that you can throw in there for them. Now let me just delete that. We're going to go back up here, and one thing you can do is utilize in T-value what we call special series. Excuse me. If I just click in this box right here, it brings up some options I have. Interest-only payments. I can do fixed principal plus interest. I have a monthly skip that maybe you build in. If somebody, let's say every tax year, they get a decent tax return and they want to apply that and pay a lump sum of money every April, I can check a box that says every April they're going to pay $3,000 and the rest of the payments are going to be $479, and T-value will calculate the shorter term that it would take to pay that off. You can increase payments by a % step. The one I'm going to go over today is an amount step. And what I can do, now there are different options. I could lower the interest rate down. It's at 6%. I can lower it down to 2 or 3% and gradually increase that rate back up. You can do that. Or I can just lower the payment amount. And I think one of the keys with this is just to make sure this payment amount that you lower it to, so let's say we lower it to $279, take a couple $100 off, you want that to cover the amount of interest that's calculated. Excuse me. And then from that $279, what you're going to do is increase it by $50, let's say every 12 months. Now, I could do that, $25, $100. I can increase it every month or every 6 months or every 24. That's up to you. You can do it however it works for you. So let's say we're going to do that. And then now what we want to do is solve for the number of payments it'll then take to pay that off. Let's actually say they're going to do that for the next 5 years. Because what that'll do is bring it back to the $479 payment. And then what we would do is do $479 and then see how many, keeping that payment flat for the remainder of the time, how long it would take to amortize that out. And this, you'll get this box occasionally whenever this payment amount or this rounding amount is different than the actual payment, which was $479. And you can either add it to the last $479 payment. So for example, it might look like this. So you can see that this is amortized out farther than the 30 years, So one thing to keep in mind is most loans, mortgages are going to pay off in, 7 to 10 years. Now, you can either leave this amortized out or you can even balloon it and whatever you might put into the agreement or whatnot. So let's say we had 107, 113, and then we'd only have 7 payments here, and then maybe create a balloon roughly around a 10-year period. So you can do something like that. If the time comes around to that, you can then re-amortize the rest of the loan or whatever you would need to do. So you have a lot of options there to make that work. I remember working with the credit unions and banks. A lot of times they'd amortize it out either to 30 years or even 40 years to reduce the payment and provide that concession to help out that borrower.
Very, very robust. Wow.
Okay, so just to kind of get those creative juices flowing a little bit, and maybe you're thinking of some different ways that you can help out your borrowers, but keep that in mind. They do have a lot of options. It's not just a fixed interest rate over a period of time or just lowering it to an interest rate. You can really get creative and make it work out for that borrower.
Very cool.
So let's go back to the slides here for a moment. So I gave you a couple of handy options here to think about. Now, as I kind of move into a little bit with the partials, some of the easy things to do in T-value would be, answering this question: how much should I pay for a note or partial? And I'm kind of surprised sometimes how often I get the question on how much should I pay for a partial versus how much I should pay for a note. It's all the same conceptually on doing the calculation. It's a payment amount over a period of time. You're discounting back at a yield or a rate that you want to achieve on your investment. So it doesn't matter if it's a partial, it doesn't matter if it's a full note. You essentially can enter in a payment for a number of payments and discount it back at your yield to figure out what you should pay. And you're going to see that doing present value calculations and T-value is very easy to do, regardless of the payment structure. So I know a lot of times people have irregular payment structures, whether it's $500 for 5 years and it's $600, or maybe it's just 5 or 10 years of a partial and a balloon at the end or something like that. It's just a matter of entering those cash flows into the program and solving for the loan amount. So pretty easy. So I'm going to show you how to do that here. And this is a different note, but let's say this one's $89,137 as balance at 9%. Payment is $904.09. There are 180 payments remaining. So it looks like this. I can back into any one of these variables to verify whether this information is accurate. And then what we're going to do is answer a couple questions here on what should I pay for a 15% return, or what should I pay for a 12% return. Both of these pretty easy to do. So again, we'll lay it out in this fashion, and just keep in mind here, the interest rate in doing this calculation is going to be my desired yield that I would want, the 15% or the 12%. The unknown variable is the loan amount or the present value or pay price, whatever terminology you want to use there. So let's take a step over to T-value. Excuse me. Apologize, I'm kind of got a little cold over the last couple of days, so trying to work through that. Okay, so we have this note here. It's $89,137.40. Payments are $904.09 for 180. Okay, so I can, if I wanted to just kind of verify what that is, which I probably want to do in almost all cases, just to make sure everything ties out appropriately. It's 180 payments. Everything looks good. One thing to keep in mind, too, is a lot of times on mortgages, maybe not on the partial so much, but a lot of times the last payment is a little bit different due to rounding. You can always verify what that amount would be here, 13 cents. So if you notice, maybe even on your own mortgage, your last payment is 50 cents off or 30 cents different or something like that. It just comes from the rounding. So in this case, if I want to determine how much I should pay for 15% yield, I just go in the nominal rate, put 15. How much do I want to pay for this would be my loan amount, and that's going to be my unknown with these cash flows. So how much should I invest to get a 15% return on these cash flows in 904 for 180 payments?
64.
So I would pay $64,596, and if I invest that amount, and in a perfect world, I get 180 payments of 904, I'm going to get a 15% yield. Not bad. Pretty easy to do. What if I wanted a 12%? Not any different. Change the interest rate, solve for the loan amount. I get $75,330. And keep in mind, what I'm solving for is the number of payments that begin on this day. Okay, so in this case, it's the remaining term, but as I kind of move into doing the partials a little bit, this is a key date to put because maybe most of the time people selling a partial or selling the front end, but if you sold somewhere in the middle or a date that's starting 5 years from now or a balloon that's in 10 years, you want to make sure this date is appropriate to what that's going to be and what those cash flows are. So you have options here. When it comes to structuring these deals, you could do what we just did there and contract to sell or broker this whole note. So essentially, buying it for 15% return, paying $64,596, maybe turn around and sell it to an investor who wants a 12% return. If you just broker that deal or contract to sell that deal, you're going to come out with a $10,000 profit on that. That would be maybe one way to go. I think a lot of times it depends on what your plan is. Another option, create a partial by buying the whole note and selling half of the payment amounts, reducing your investment, and your yield may even go up. I'm not going to run through this calculation because I want to show a different one on the partial, but we're kind of using the same note. So I'll just kind of show you what this looks like. Again, if I'm selling half the payment amount, as I mentioned, it doesn't matter if it's a partial or a whole note. When you do the calculation, you want to enter in the cash flows that you are looking to buy, the cash flows that you want to discount back at your yield to figure out what you should pay. So if I'm going to sell off half the payment amount or the 452.04, I would then discount that back at 12%, solve for the present value. So in that case, I would, at 15%, pay $64,596, and if I were to turn around and sell to an investor who wanted a 12% yield, I can determine really what I would want to sell. So in this case, it's the partial, the 452, but it's 180 payments of it. So I discount that back at the 12%, it's $37,664. Therefore, reducing my total investment into this deal, I'm not getting the whole $900 payment, but I'm reducing that down to $26,932. And then what about my yield? Well, my yield goes from 15% to 18.9%. So there's some different ways to kind of get creative there. So it's an option, and I think it depends on what your need is. Maybe you want to have a little more cash up front, or maybe you just want a lump sum like contracting the deal, or maybe you just want the tail end, you're trying to save maybe for retirement. So you have the option to contract to sell or broker the deal. You can do half the payment amounts, or you could even receive some cash up front and have payments in the future. Now, this one's a little tricky, but I'm going to show you how I kind of got to this. So you could sell enough full payments as a partial for the investor to get a 12% yield. In this case, it's 67,047, and I'm going to walk you through this one in T-value. I'm going to turn around and give the seller his 64,596, which gives me 2450 up front as my discount fee or whatever commission you want to call it. It's a win-win deal. The investor got his 12%. I'm getting what I want out of this deal. It's a win-win. So I'm getting some money up front, and we're going to walk through this one because it's a little bit tricky on this, kind of to show you how I got to that amount. But here they're going to 136 payments on the front end, so that's going to be the key date to enter into T-value to to discount back those cash flows appropriately. Our interest rate of 12%, the present value being unknown, and our payment amount of the 904. I'm sorry. So let's let me see here. So let's show you this because, like I said, it's a little tricky. But I think, and the reason I say that is because how often are you going to give somebody a partial where they might have, let's say, 136 payments and then one more payment of $137 or $643.24 or something. You want to give them the whole payment amount. So there's not kind of a little discrepancy on what that other payment looks like. So what I, in this case, was looking at, it was $64,596 on that I'm going to pay for the note. So I wanted to kind of say, well, what if I were to get, a couple $1,000s up front? So let's say I just kind of put in, if I invested $67,000, I wanted a 12% yield on this payment of $904. How many would I get? So you get this rounding amount of $713, which is different than the $904, and this is why I would back into the investment amount. So what I do here is, here's tell me $135 plus that odd payment. So maybe I say I'll just move it up to 136 payments. Then I'll back into what the investment amount will be, $67,047. So that's how I got to that amount. It's clean. They get an equal number of payments. No irregular half payment or a third of a payment or whatnot in there. So it keeps it clean, and I get a little bit up front. And another thing I want to do, and moving into the partials, and I'm just going to show you a couple things here, because a lot of confusion that I've kind of seen with regard to, Schedule B or the partial. Let's see here. All right, here, just a summary on this one here before I move into the partial or Schedule B. So in this case, the $67,047 was the amount that the investor is going to pay for 136 payments of $904. I give the seller $64,596. Okay, so therefore I keep the $2,450 up front. And what about payments 137 through 180? Well, you get those 44 payments of $904 and a total profit of the $42,230. And the question some people might ask is, well, what's my yield on that? In this case, I didn't put any money up for the deal. I got $2,450 up front plus payments in the end. I think that's a pretty good deal, and don't really need to calculate what my yield is there because it's infinite.
I would say so.
So let's say we work this out, and now we have a partial of 136 payments of the 904, and how do I create Schedule B? And sometimes the thing that's confusing is the confusion between the investor basis schedule and Schedule B. And I know sometimes people even, terminology is a little bit different. So in my definition, Schedule A is what the borrower is paying. Schedule B is the piece of that pie or that partial that I'm selling or that an investor buys. Okay, so it's a slice of the pie. And then Schedule C would be then what I would get in the end. So Schedule A is what the borrower is paying. Schedule B is the partial that the investor buys from me. Schedule C would be mine, the remainder interest on that. And a lot of times the confusion is which interest rate is for Schedule B. And I think sometimes people confuse the interest rate with being the yield, which would be your investor basis schedule. So Schedule B is going to be at the note interest rate. So when you discount back the payments at the note interest rate, it's going to calculate the value of that portion of the note or that piece of the pie. So it's important to know. I mean, the investor basis schedule is going to be important for you and your tax-related purposes, but not for the partial. So it's going to look like this: 136 payments as a number. Our interest rate is a 9% that we're going to discount back to calculate the present value of those 904 payments. And let me just go through here. Also, you can do this with Schedule C. I'm going to walk you through just in T-value real quickly and show you a master schedule of how this kind of lays out and adds a lot of clarity. But you can do the same thing with Schedule C. Now, this is going to be where the start date is key. So payments of 90409 at 9%. It's 44 payments, but in T-value at least, the key is entering these payments to begin at payment 137. So how many? It's 11 years, a little more than 11 years down the road. I need to make sure that that date is appropriate when I calculate that. But in this case of what I'm going to show you, you don't even need to go through that exercise on Schedule C, at least in this case. So this is how it would look like to do Schedule C. And then from that, I'm going to show you what if the note pays off in 5 years. So just to show you quickly in t-value, what I mean by that is this here, this is our basis schedule right here. It's at the yield that the investor is getting. So when I need to calculate Schedule B, I need to change this nominal rate back to 9 and solve for the balance based on that interest rate. So then that's going to show me here's the piece of the pie of that 136 payments. Okay, now let's go to my spreadsheet. Now what I did here, oops, let's go back, sorry about that. Okay, so what I've done here is essentially exported these schedules from t-value. It's one click, takes about 3 seconds to export each schedule. And what I did was took Schedule A, which is what the borrower is paying on the balance of the $89,137. It's 180 payments of the 904. Okay, so that's what the borrower is paying. Schedule B is going to be the partial. So the balance that I just solved for, that present value at the 9%. Okay, Schedule A, Schedule B are at 9%. Now what makes this really nice,
Hey, we just
lay this out.
Here, Marcus.
I'm sorry?
All we're seeing is the note conference screen. We're not seeing it. Were you supposed to be showing a spreadsheet right now?
Yes, let me go back.
Got it.
Yeah, not sure what happened there. Sorry about that.
No problem.
Okay, so again, what I did was export these schedules from t-value one by one, and I basically copied Schedule B and pasted it right next to Schedule A. And the important thing is that these payment rows line up, because it was kind of a nice little ringtone there or whatnot that Dave Krunick gave to me one day. He's like, oh, it's really easy. It's just Schedule A minus Schedule B equals Schedule C. Okay, well, that's easy enough. And we went through some different examples just to kind of verify how that would look. And all I'm doing is taking Schedule A, which is the balance here, minus Schedule B, which is what the investor is owed.
We lost your screen again, Marcus. I don't know why that keeps jumping out. It's back.
Okay. So all I do is a plus minus of these columns. A minus B equals C. So at any point in time, this is what the borrower owes. This is what the investor receives. So let's say in the scenario we said, well, what if this note pays off in month 60? Well, the borrower is going to pay the $71,370. The investor is going to get his $52,228, and I'm going to get the $19,141. Keeps it pretty simple, pretty clear. At any point in time, I can look at that. Now, in the case that payments were missed somewhere along the way or lump sums were paid, I would basically go back into t-value, enter those payments, re-amortize the schedule to make sure everything ties out appropriately, and then I can reset this master schedule so that everything is up to date or current for that situation. Okay.
Very slick.
So just to finish up here, sorry, moving some of the stuff here out of the way. Okay, so just to kind of summarize this here on the Schedule A minus Schedule B equals Schedule C, the $71,370 that the borrower is paying minus Schedule B, which is what the investor at the 12% receives at this point in time, leaves me the remainder interest of the $19,141. So just a nice way to be able to lay that out and add some clarity to the situation. And just a little summary of what we went over today. As far as creating or verifying a Schedule A or what the borrower's payment schedule looks like, whether it be from the original note or from at any point in time when there's been some transactions occurred or missed payments or whatnot. Getting a little creative in the workout scenarios and providing some options and not being kind of one-sided on how you would do things, but just to be flexible and use your creative mind a little bit. Calculating pay price, which is very easy, brokering and selling partials, creating Schedule A and B separately, and in my scenario here, I think it's a good idea to create a master schedule. And last but not least, determining who gets what, A minus B equals C, keeps it simple. All right, so that's about all I have here, my contact information for anybody that does have questions. and or want some help if you are using T-Value. And one thing I wanted to note, I wanted to give a little discount to anybody that's attending today. Now, we have two versions of T-Value right now. One is our desktop version 5, probably is what most people have seen. We will have a version 6 coming out very soon. But T-Value is normally $149. If for anybody that's in this webinar presentation, you'll get our discount of the $119 discount rate. You can always have an option of adding on maintenance, which gives you unlimited phone support, gives you the ability to call us anytime Monday through Friday and actually get help. Somebody picks up the phone here, and you can say, can somebody help me with a calculation? And you can say, is Marcus there? I want him to help me. I'll be available most of the time and be able to help you out and walk you through the calculations. On the T-Value Online, which is what I went over today, this product's been out for about a year and a half or so. We've got a ton of users that are using it, and it's based on $5 a month, which is $60 for the year. It is subscription because it's a cloud product. I want to offer it. Doesn't seem like a huge discount, but $4 a month takes it down to $48 a year. Gives you a savings, and a couple options for desktop or the cloud if you want to use it on any computer, Mac, or mobile device.
Cool. Well, listen, Marcus.
Any questions or anything that I can answer for the remainder of the time?
I learned some stuff here. Yeah, let me open this thing up. Let's see. Anybody?
Mike, you've been using the product for a while, and you still picked up a couple things. That's nice.
Okay, so yeah, we had somebody who's interested in the cost. So Bob, that's what it'll run you. And yeah, I mean, I didn't know that you could do uneven cash flows like that. That's pretty funny. I've been using another tool to do that, and so that was wonderful. That whole expansion, I had used that a while ago and then kind of forgot about it.
You know, it's interesting. You know, we started doing T-Value webinars a few years back, maybe 5 years ago, and you know, we have customers that I'll talk to sometimes that I think I was one of your first customers. You know, back in 1984 or 1985, and I think just as you mentioned, you know, I think sometimes people. And even, you know, it's something that you experience with Excel, but you get used to using something a certain way for certain things, and you don't realize the capabilities of it. So at our webinars, we always get people that have been using T-Value for 10 plus years, 20 years, and pick up a ton of new tricks and things to do in T-Value. So
yeah, no, that was awesome. And I'm sure that I'll get some questions coming through here as we you know, as more people view this recording and as some of these guys get more experience doing their own workouts and stuff, it's just going to grow.
And if anyone wants to give the online version a try, because it's one of our new products, we do offer a trial period. So if somebody wanted to use it for 30 days, no charge. We don't take any payment, information. So you can try it out. You can utilize me over the phone for help. And like I said, I find that just with a little training, people are off and running, just with the basic understanding. And I think just conceptually, when you understand how to enter the cash flows in there, and go over some of the creative workout stuff, it really expands your mind on kind of how to use the product and just how to be creative and help your borrowers and have creative deals. I think sometimes that can be more compelling for other investors if you can be a little creative and flexible.
Well, yeah, I mean, just putting pricing on partials or putting pricing on what you can pay to give yourself a yield of the yield that you expect, you're actually kind of setting yourself up with an advantage when you say, I can pay this much, here it is, and take it or leave it. And they're like, oh, that's a lot of money. And they don't know how you came up with it. They're like, take it.
Yeah, I don't know if you know Tom Henderson's, but he has a lot of tricks with calculations, and he's been using T-Value for years. I've always seen him out at the Paper Source conference, where I'm sure a lot of people go. But he's got some really unique ways of structuring deals and doing some of these calculations. So
very cool. All right, so let's see what kind of questions we have here. All right, so MJ was wondering what other type of training. Is there further training possibilities? Let me see.
Well,
let me pull that.
As far as training, one, I am always willing to help people get started because, a lot of times people in the and as no investors using HPs or Excel or whatever it is that we get comfortable using, and if there's not a compelling reason and an easy learning curve to some extent to be able to use something else, it's hard to see the value in it. So, if people have deals that they're working on or something that they just did, I like to go through that because it's real life, and to go through and show somebody how easy it can be to do it. Not only how easy it can be, but the fact that you can call us and get help over the phone and somebody walk you through the deal and how to make sure you have it entered correctly. I just found there's a lot of value in that, and it just gets people off and running on how to use it. And
Awesome.
We have videos, we have webinars, we have over 75 tutorial videos, plus the unlimited phone support. Got a couple of recorded webinars as well. And of course, Mike, you're going to record yours so people can refer back to it.
Yeah, cool. So Eric had a quick question. Schedule B, Schedule C, Schedule A, what is that actually referring to? He was wondering if you could explain that.
So Schedule A, if you look at Schedule A, and you're going to hear the terms used a lot in the industry, and I know Schedule B is one that people have used different terminology for, but the people I've worked with, a lot of speakers that I've come across, keep it as the Schedule A, B, and C as I was kind of utilizing here, and Schedule A being really it's the note that borrower is paying. So if you have a mortgage and you have a note on your mortgage, Schedule A, that's Schedule A, that's what you're paying. It's the note at the note interest rate for the full term of what's left on that note, and that's what the borrower is paying.
That's
That's
not the profit or anything like that.
I'm sorry?
Yeah, that's the person generating the capital.
Schedule A?
Yeah, I mean, these aren't actual tax schedules, are they?
Did you say tax schedules?
Yeah, like this isn't like IRS language, is it?
No. Schedule A is just the normal mortgage on the home. That's what, or what you might be buying when you buy a note. That's essentially Schedule A. Okay. And you probably don't use that term until you're talking about partials to differentiate. But the Schedule A is just a normal note or mortgage on a property. Now, usually the time when you start using Schedule A and B is that when you get to Schedule B, and that's the partial, and then maybe one of the easiest ways to think about it is it's the piece of the pie. So Schedule A is the whole pie. And if I take a chunk out of that pie and I give it to you or sell it to you, that's Schedule B. So it's right out of the same note at the note interest rate. I took a piece out and gave you. So that piece has a certain value.
Got it.
And that's what we did with taking the 136 payments at the note interest rate and solve for the present value. It gives us the value of what that piece of the pie is worth at that point in time based on the note interest rate. So that's what you bought. You bought that piece of it. Now, that value changes as payments are made or as time goes on. So, as those payments are made, it starts to go down. But you still are owed a certain amount of that principal amount at the beginning, less those payments at that particular interest rate. So that's, as we did in that master schedule, looking down 5 years later, what is the balance there? That's what you're owed. So on Schedule B, if you own Schedule B or that partial, that's what you're owed at that point in time, whatever that balance is. Mm-hmm. Given that in a perfect world, all those payments were made as they were, and we didn't have to readjust anything. But that's what you are owed. And then C is just the balance of A minus B, which is Schedule C. So if I sold you out the partial, Schedule C is what I get. So whether it's the back end or the other half of the payments or whatnot. So hopefully that helped a little bit. But call me anytime for more clarification or send me an email.
Okay, Marcus, thank you so much, man. I really appreciate it. Everybody has really gotten a bunch of stuff out of this. And if you want to hang around, Marcus, for the deals part of this, we sit around and talk about the notes that everybody is working. So, but again, thank you so much. Reach out to Marcus, guys. And Appreciate it.
Yeah, thanks again, Mike, sorry, is it Bruce? Sorry.
Bruce, thanks for setting all this up, Bruce. I appreciate that.
Oh, you're welcome. Thank you, Marcus.
Thank you very much. I appreciate it. And I'll stay around here for a couple minutes for any questions or anything.
Okay, cool. All right, so let me take back the, of course, if there's any more questions, feel free to just type them in, guys, or raise your hand, and I'll just have you be able to speak right out. And so let's get right into our deals that we're all working on here. Let me get to my attendees. All right, so who do we have on the call tonight? Okay, Bob, I'm going to unmute you, Bob, and I think I saw Jennifer on here too. No, looks like she jumped off again.
Oh, okay.
Bob, how the heck are you?
I'm pretty good.
Well, good. I guess you're the first attendee for the for our note session that we're going to have over here in May. So
May Mastermind. What are the dates on those?
It's
I don't know that you've
Cinco de Mayo. It's May 5th. May 5th to May 11th. We're renting a big house over here in Bay Head, New Jersey.
Right. Yep.
And we're flying in. We're going to have a bunch of really good note investors show up, and we're going to sit around and eat and drink and talk about notes.
Mm-hmm.
So
yeah, I know Jennifer is trying to figure out if she can go to that because the timing is like the week after the Paper Source conference in Vegas. So
oh, you don't want to go.
Your timing's okay.
Oh, good.
Well, I want to go to that, but yeah.
Okay.
I want to go to both of them.
Bob wants to go to everything.
Yeah.
Good. How's your deal going?
Well, we checked in with Madison Management today, and our borrower Jimmy got the the shock and awe documents to fill out for tax returns and W-2s and all that good stuff. And he says he's working on them and going to get them in the time that Madison requested. So again, going forward, he's saying and doing so far all the right things that says he wants to stay in the house and work something out.
Great, awesome.
So
yeah.
we're pretty happy.
Yeah.
We're very happy with Damien at Madison, by the way.
Great, awesome. I'm glad to hear
I'll put
that.
in a point for him.
It's not easy being a servicer, let me tell you.
No, or even less easy being a bill collector.
Exactly. All right, Bob, well, good. We'll, I'm sure we'll hear from you next week, and hopefully you get a big old check out of that thing.
We hope so.
You're good. All right, Bob, thanks.
I'm sure.
Let's see, Anna. I don't know, Anna. Anna, are you there?
Yeah, can you hear me?
Hey, how are you?
Good.
How's your deal?
So I was trying to do client managed, and I wasn't getting anywhere. So I really don't want to foreclose. I just think it's a waste of money because I think they're going to pay it at some point.
Okay.
So I turned it over to Madison Management and talked with, and it wasn't Damien, but it was another person. And he's reached out, made a bunch of phone calls. He's suggesting maybe do a door knocker. So I just got to get on that website tomorrow morning and sign up.
Oh,
And I wasn't sure whether to sign up for 2 door knocker or 3 door knocker. I didn't know. What do you think?
Well, first of all,
Like 2 attempts or 3 attempts?
Who's the company you're calling?
Madison Management.
Okay, so
Oh, what?
Say it again.
I don't know who they use.
Okay, so you have to get onto Madison Management's website.
Yeah.
Okay. So what's the cost basis? Like 1, 2, and 3? Is it ridiculous?
It was either I think it was $70 for 2 attempts or $80 for 3 attempts.
Yeah.
Or maybe it's up. I was thinking the 3.
Yeah. I'll do 5. Yeah, that's great. Yeah, so try everything all at once. That's perfect.
So I think that's what I'm going to do. And if that doesn't work, I'm kind of thinking of just sitting on the note rather than spending a lot of money on a foreclosure. But that may be what it takes.
I do that all the time. People look at me like I got 3 heads because I do that. But I do it for several reasons. It lets the borrower get into a different place. A lot of times, the borrowers think you just went away, right? If this thing's been sitting over at some other hedge fund for 3 years and they haven't done anything with it, and then I get it, I do a few attempts, and then if I let this thing sit, well, at least they know that, we got a new company here. I wonder how far they're going to go with this. I wonder, maybe if, the borrower says, maybe if I put my head down for 6 months and really work and scrimp and save some money, but next time they call, I'll be more prepared for them. So they know that you're lingering. They know that you're around. They kind of put their mindset into thinking that we are going to have to do something with this sooner than later. And then you knock, on the door a year from now or 6 months from now, they may be more ready and more prepared to work with you. And, as long as you're not playing with scared money, you can afford to sit on these things a little bit longer and give them some time to mature. And while they're doing that, all the while they're paying down further their first mortgage principal, which is building up your equity position, and they're getting more and more comfortable in the house that they live in. So if you give them another 6 months or a year, reach back out to them and see if there's something there for you. That's a beautiful thing as well. So, I know one investor who bought up all the no equity California notes, and he just sat on all of them. I don't know how much he spent on those notes. And then a couple of years ago, he pulled them all out of the drawer and dusted them off and started foreclosing because all the equity came back. All the borrowers were in much better shape. The world was a better place to live, and now he was just cashing in. And so, yeah, there are situations that I will sit on those things, so don't feel bad about that.
Well, and it was interesting what Marcus was talking about, just reminding us all that a lot of these notes turn over in 7 to 10 years.
Yeah. I mean, it used to be, I remember back in the day, the number was 4 years. Everybody bought and sold their house or at least did a refi every 4 years. And that was in a real hot market. So let's take that and double it now because we're not in the greatest of markets. We're not in the worst of markets, but we're not on fire the way we were back in 2005. So yeah, 7, 8 years is a realistic number, and you may go on Zillow one day and see this thing listed. So, all right, well, cool.
Right.
Yeah, let us keep us posted on that, and we'll see how that door knock thing works out. What's the door knock actually going to deliver?
I think just like the options letter, which I had sent him an options letter earlier, so this will be kind of a repeat a couple months later.
Okay, and it's going to be Madison's phone number and not yours?
Yeah.
Okay, give it a try.
Yep.
Cool. Well, good luck.
Thanks.
Have a good one. Okay, so let's see. Who's next on that block here? Oh, it looks like we got Neil on. Hey, Neil, I see that you logged in twice. I don't know which one you are, so I'm going to unmute both of you.
That's me.
Are you on twice?
It might be Lisa.
Oh, hi, guys.
How are you?
Long time, man. Long time.
I had some technical difficulties with that Surface Pro. I returned it after about a week. I couldn't deal with it. Oh,
okay.
And I just bought myself a new Mac, and it's so much better for me.
Yeah, it's got to work for you, So how's your deals going?
I'm sorry, I didn't hear you.
How are your deals going?
Good. I mean, we have, I'm not sure if I told you, we settled one in California. So I guess for people that aren't familiar, we had a note, I want to say it was $30-some thousand debt on a second, with house with equity. No answer. Early on he answered and then went He didn't answer the phone. Basically said he didn't owe the money. After going through these now a couple times, I'm under the impression that foreclosure is the only way. So we foreclosed. Foreclosed. Started the foreclosure. It was about a $1,200 investment all in all, and we just settled for $20,000 payoff. So that one went well.
Good. And you used trustee corps for that.
Yes.
And well, perfect.
Come on, can I please?
Um,
Old variable, all the variables.
Okay.
so what was the other? The other we have we have a foreclosure date set for the end of October for a property in Arizona.
Okay.
We stopped the foreclosure once. We thought there was going to be a payment. There wasn't a payment. She still hasn't filed any bankruptcy or anything. So the foreclosure date's probably going to happen unless she sends us a check before October 30th.
Yeah, that was the older woman with the daughter, right?
Yep. And, we've given her every opportunity, and
Sure.
so there's equity, but we're end up, I've been talking to several people about this, and at the end of the day, more than likely, we're gonna go to foreclosure, set a sale price for the full amount. More than likely, someone probably won't buy it. Although my understanding is Arizona is kind of interesting because in order to buy a note, to buy at a sale, they need to put a $10,000 non-refundable deposit down. And what happens in some of these cases is some people don't know what they're doing, and they buy this note, they put their $10,000 down, and they realize it's a second mortgage,
Yep.
and that's what they're buying, and then they back out. So I've talked to somebody who sold a note 2 and 3 times in Arizona. So, but more than likely, the other thing that could happen is we may still foreclose, not get a sale, and then continue to do the workout with her. And then if we have to, back out of the foreclosure, if she, so be it. But apparently you can reverse the foreclosure in Arizona.
Good.
So that,
and now, how about your Tampa note?
that one, actually more paperwork went out. He actually doesn't speak English, apparently. And so we had someone speak to him in Spanish. We just sent him basically a review of all the paperwork in Spanish for him to decide. He seemed receptive when we spoke to him several weeks ago about trying to straighten this out. But at the end of the day, he's going to get this paperwork. We're basically asking him to find somebody who speaks English that he trusts, that we can talk to with him. And if he's willing, we may be able to work it out. If not, that one will foreclose as well.
Okay. Now,
And
just
then,
to let you know,
yes.
I drove past that note back in January.
Right.
And I saw a lot of men in that house. It's a pretty good sized house. It goes real deep into the lot.
Well, apparently it's Lisa spoke to him. It's the guy who has the second. That is, the house is owned by his sister.
Okay.
His sister is paying on the first, and he apparently didn't know what happened and just kind of stopped. So, listen, I'm optimistic, but only a little bit. So, well, more than likely, he'll need a wake up call from the attorney as well. But
yeah,
that's
just the reason for my making that comment is it looked to me like they were all making money. There was a lot of we kind of staked the place out a little bit. And
right.
There was a lot of men in and out, and they all looked like they were on their way to work. And we went back in the afternoon, and it looked like they were all coming back from work. The place looked like a parking lot.
Got it.
And they all looked like they were of means. It didn't look like they were destitute, So if each one of these guys that's living in that house has
I think I'm a little more optimistic with this one, just because he seemed receptive on that first phone call. But again, with the language barrier and what our experience has been, people will talk to you in the beginning and then they kind of dart their head under the ground for a little bit.
Mm-hmm.
So we'll see. I mean, it's just a matter of time. We just sent out the paperwork the other day in Spanish for him. We had, we went on Fiverr and had all the documents translated into Spanish. And then I had a friend of mine review all the documents to make sure they were said what they were supposed to.
That's a great idea.
And this way, basically what the advice I got from most people was you can't translate the real documents. They all have to be signed in English to work in our court system. But my feeling was if he's receptive, we'll give him a chance to get these instructions in Spanish and see if he responds. And if he doesn't, then he's full of crap. I mean, and if he does, well, then we're happy to work with him in Spanish.
Cool.
So, and then we have the one in New York. That one, believe it or not, is now, it really appears that it is a first mortgage. There is no second mortgage that we can find in any way, shape, or form. And we had someone go by the house. It looks in good shape.
Mm-hmm.
And we thought there was a tenant in there, but we just filed to start collecting rent with the attorney, and apparently there is no tenant in there. So we are just pressing forward. The foreclosure should happen, in the next, 4 to 8 weeks, I'm guessing.
Beautiful. Beautiful.
So that one really could be the best one of all, because if it ends up being the first mortgage with no second, we bought that one just right.
Boom. That's awesome. That's great.
So things are moving.
Anything I can help you with?
I'm sorry?
Anything I can help you with?
Well, actually, right now, things are going well. I mean, it's just lots of, like everything else, it's just a lot of busy work. Lisa does all that.
Well, great. If she can hear me, tell her I said hello. And it's good to hear from you guys, and I'm glad to hear that you're moving through these things, and keep me posted.
Yeah, we're chugging. Hopefully, we'll have more good news.
Sounds good, Neil.
Take care.
Thanks a lot. Have a good night. Okay, Nick. Let me send Nick a pin. I don't know if Nick can get on. I don't see them on. I guess everybody else is good. Okay. Yeah, so Marcus said, thanks a lot. Talk to you soon. And if anybody has any questions, you can pass those questions through me, or you can pass them through to Bruce, and we will get them answered. What I wanted to do was all the people that have purchased the Note Conference Surface Pro education program, I'll go ahead and give everybody a year's subscription. If you're part of that, program with us, you know who you are, and so get your request in, and I'll get you signed up for a year's subscription to the, I guess it's the online one. I think that's the best because you can pick it up on your phone, you can pick it up on whatever computer you're on. Okay? So if you're on No Conference 3.0 education, I think 4 or 5 of you are on there tonight. Go ahead and shoot me over an email, and I'll get you that subscription. I'll figure it out with Marcus tomorrow on how I can gift that over to you guys. All right? Bruce, any things that we need to close on here?
There's just one question from Jason. Do you have any videos about how to make partial note offers to sellers? I might have missed that discussion earlier.
Yes, that is prior to, I guess, him getting on. So this recording would be it. But no, I mean that's a great subject for a webinar one night.
Mm.
I'd love to give you my 2 cents on that whole possible stuff, and that's it, my friend.
Really good stuff.
Yeah, cool. I'm glad everybody was able to jump on tonight. Looks like probably the most people we've had on. I guess it's that summer thing is all over, and people are getting back to thinking about how they're going to get rich and famous and retired and all that good stuff. So well, I'm glad to see everybody on here tonight. Thanks so much for your time. And Bruce, It's always a pleasure working with you. Thanks for setting that up with Marcus. That was an awesome presentation.
You're welcome. Thank you.
And good job with that. All right. I think that's it, folks.
And on to NoQuest for tomorrow night at 7.
NoQuest tomorrow night, 7 p.m. Eastern. Okay. And thanks again. I'm signing out, and have a great night.
Good night.